Unrealised tax on your superannuation. If you know what I'm talking about, you've probably just lent forward that little bit more. If you don't know what I'm talking about and have been diligently building your superannuation, you need to understand what I'm going to tell you. Because the government could be about to start taxing you on gains you just haven't even realised yet. I know this sounds crazy, but this is actually starting to happen. I'm Jeremy Nitzelli. This is what school should have taught you. Let's get into today's episode about the unrealised taxing of superannuation income.
Everything school should have taught you in one place. With a property portfolio of over 17 million and an accountancy firm of over 16,000 clients, as well as being an accountant to some of the wealthiest people in Australia, Jeremy Nitzelli will be sharing his lessons on everything school should have taught you so you can build the life you want.
You would have been hearing all the way throughout the election about a Liberal scare campaign regarding the unrealised taxing, or now the desensitised name of the tax being called Division 296. Now, this name is out of every known playbook that the government has. Call it something that people have no relationship with, doesn't have a scare name, and it goes through without a hitch. But really, this Division 296 is the unrealised tax on total superannuation balances above $3 million per person. Call it what it is now a money grab that they're trying to say that they're taking it from the wealthy. I've got my own opinion. Wait till the end and I'll share it with you. But I actually want to show you live a scenario because we've seen so many podcasts, there's been so many articles about what it actually is. But I'm going to break it down for you on a numbers perspective so you can start to see what this tax looks like with real numbers of someone's portfolio. Now I'm going to use Peter. Peter, as at 30 June 2025, had a TSB, and I'll reference that quite a bit. TSB stands for Total Superannuation Balance of $4 million. Now again, Division 296 has just passed the lower house at the date of this recording. It still has to pass the Senate, and then it will be legislated. But from 1st of July 2025 onwards, we're assuming this tax is going to be in place. Peter, at 30 June 2026, now has a balance of $4.5 million. Now that balance of $4.5 million less the original starting balance at June 2025 of $4 million, 27.5 of that came from his contributions. So roughly about 476 grand came from earnings that have not been realised yet. Now what realised means? It means cash. Unrealised gains means paper gains. It's on a piece of paper. It's here today. It's gone tomorrow. On that $27,500 worth of concessional contributions, he had to pay tax of 15%, as we all do on our concessional contributions. And that gave him a net after-tax concessional income of $23,375. Now, this number is important to work out our basic earnings for Division 296. Now, his adjusted TSB, total superannuation balance, is now $4,476,625. That's the $4.5 million worth of total super balance, less his net after-tax contribution income, which was that 23 grand. Now, we need to work out what they call the basic earnings. This is the formula for your basic earnings. It's the 4.476 less the $4 million balance that he started with as at 30 June 2025. And we get our basic earnings for Division 296 now at $476,625. So basic enough maths. Now, if you've stayed with me this far, it's going to get juicier because now you're going to see where the rort starts to happen. We now need to prorata that basic earnings. Now, what a prorata means is working out of that $476,000, what level of that earnings has come from below $3 million and what level of that earnings has come from above $3 million. So that $1.5 million increase that he had. And the formula is easy enough. It is looking at his $4.5 million total superannuation balance as at 30 June 26, so that number there, minus this $3 million non-indexed cap. Now remember, the government said we're only going to attack people and make them pay tax on unrealised earnings when your members' balance or total superannuation balance is above $3 million. So we need to work out of that $3 million cap, how much we've exceeded it by, which is nice and easy, 1.5 mil. We need to divide it by the ending balance of 4.5. Now we get our proratement percentage, 33.33%. Now, in layman's terms, of the $4.5 million balance that we have, 66% of that, of those earnings has come from the cap of $3 million or below, so we don't have to worry about the Division 296 unrealised tax. and 33.33% of that $476,000 earnings has come from your balance above the $3 million cap. So hopefully you followed that with me. Now, we need to work out what our Division 296 tax is, or this tax on unrealized earnings. Working out the Division 296 income is now taking our basic earnings of $476,625, which we did get from taking the $500,000 increase, less the concessional contributions, less tax, times in it by our proratement percentage, because we've worked out that 33% of that 476 has come from earnings above the $3 million cap. And that leaves us $158,000, which is applicable to the unrealized tax. I know that's a lot of numbers, but if you are listening on iTunes and Spotify, I'm going to urge you to go to our YouTube channel, because I've got all this illustrated with some great drawings and also my terrible handwriting, but it will make sense if you see it. Now, once we've got our $158,000 Division 296 income, we now need to pay our tax, which is 15% of the $158,000, which equates to $23,829. In Peter's particular case, his super fund grew by $500,000, of which $27,500 of that was his own superannuation contributions, which, remember, he paid tax on at 15%. So his net after-tax contributions was $23,375. That's the amount of physical cash that went into the fund. The balance of that $476,000, that's just money on paper. That's gains that have been made through movements of maybe his properties or movements of maybe his shares. Now, what's that resulted in? It's resulted in Peter having to pay an unrealized tax of $23,829, which is more tax than the net after-tax contributions that went into the fund. So this means that of the cash, that physical cash that went into the fund, more is going out through the unrealized tax, or otherwise known as Division 296. This is where the rort is happening. Now, I know they're saying that it's only going to hit a very small amount of people, but as we all grow and as our income grows and as we become more sophisticated and more savvy with our investment, and this particular cap's not going to be indexed, more and more people are going to be captured in the Division 296 tax. So to put that in perspective, if you think back about 10 to 15 years ago, if you were in the market or the economy and working, you could buy properties for $300,000, $400,000. The median house price was maybe around the $600,000, $700,000 mark if we're lucky. Today in New South Wales, the median house price is well over $1.3, $1.4 million. An entry point here into New South Wales, or in most places around the country, starts at $800,000, $900,000, if not $1 million, and you don't get much for that money. So many people are going to be captured in this Division 296 tax. Let's call it for what it is, unrealized tax on earnings that haven't actually been earned yet. And that means that this is only the starting point. Now, my gripe with this Division 296 tax is that, for argument's sake, Peter, who's just paid as at 30 June 2026, $23,829, which is more tax than the net after-tax concessional contributions that he earned, which was roughly about $23,300. If his total superannuation balance as at 30 June 2027 goes down from $4.5 million to now $4 million, common sense says he should get his $23,800 back. But no, that is not how the government's going to be treating this. They're going to be taking that loss of $500,000 as a carried forward loss in the future, meaning that, hey, thank you for paying us our $23,800. We're going to bank it, spend it, do what we need to. But that $500,000 now that you've just lost in your super, unrealized that is, because he hasn't sold anything, we're going to give you that as a carried forward loss, which means you won't pay us any more Division 296 tax until you exceed $4.5 million again. Now, that frustrates me, because they can take it on the way up, but they don't give it back on the way down. My opinion is very simple. This opens the door to more taxing in other areas. Now, what would that tax look like in other areas? We're talking taxes on potentially our family home. We're now talking about taxes on trust distributions. Just recently, the Australian Financial Review released an article and a statement about Jim Chalmers, who's the Treasurer for the Labor government, talking about taxing trust distributions. We had this conversation. Bill Shorten lost an election off the back of franking credit reform and trust distribution reform. We're in a government and we're in a position now where we have foreseeable deficits for many years to come. On the last budget, which they released around April, May of 2025, they're talking about 10 years worth of deficits. Now, I will say to you, there is no one in this world that will be able to forecast more than about 4 or 5 years reliably. If they're saying there's going to be 10 years worth of deficits, the chances are there's going to be a hell of a lot more. The Labor government had some really good years during some very strong mining performance and royalties that they collected. We've got ageing infrastructure, ageing population, we've got a growing NDIS bill, we've got a substantial amount of costs that are currently in our economy that need to be paid by the taxpayer. How are we going to get that paid? If the economy is not going to be uproaring and booming, and we can see that through the reduction of potential interest rates to come in for the later half of 2025, and maybe onwards through to 2026, the best way to take money is to take tax revenue. And first they hit the tax revenue where you don't really notice it, such as superannuation. Have an index threshold, such as the Division 293, which I spoke about in a prior podcast. Have a look at that one if you want to know more about Division 293 tax. But the unrealised tax on super, the desensitised name they've given it of Division 296, for now may impact 80,000 people. 10 years from now, that number will be tenfold. 20 years from now, everybody most likely will be paying Division 296. So you're probably thinking, Jeremy, what do I do about all this? You've kind of given us a really lot of negative news. I'm sorry. The tax is negative, but I still look at super as a very positive structure. For many people that are out there, you may get close to this cap, you may exceed it, and hopefully you do. And then we'll find ways to obviously minimize it at that particular point. But you still should be looking to contribute into super. Speak to your financial advisor, your accountant. They're the people who are going to give you the best advice around retirement and tax. Superannuation is still a fantastic entity to grow your wealth, whether you want to do that in shares or industry funds, retail funds, or buying property under limited recourse borrowing arrangements. There are some great opportunities and some great tax mechanisms still in super. Obviously, when you get below that $3 million cap, when you get above that, that's where the work is cut out. Now, a couple other things to note regarding superannuation, some things that we don't know too much about, but things that I want you guys to look into when you get your own chance. We do have this cap of roughly around about $1.9 million today. It's called the pension cap. It does and has been indexed since it came in. Roughly, it started about 1.6 mil. But when you do get into pension phase, and that's say after the age of retirement, you can convert your super fund to pension, which means any earnings it generate in theory should be tax free. But that's up to the cap at that time, which at present stands around about 1.9 mil. So that was that first bit of legislation that was brought in a couple of years ago. Will allow you to convert your super fund to pension, but only up until this certain amount. All the balance above that and all the earnings above that will be taxed at 15%. Not good. We'll live with it. But then bringing out the Division 296, unrealised tax on super, that's them just getting a little bit more cockier, starting to bring in a little bit more taxes, which now opens the door for other taxing arrangements or regimes to come in. So it's important, if you're getting close to this $3 million cap, speak to your accountant, speak to your financial planner, work out ways that you can start to minimise what this unrealised tax looks like. If you're nowhere near that $3 million cap, don't worry about it. Don't ask the question. Still look at super as a great vehicle for building wealth, as a great vehicle for your retirement. Now, I've given you guys only one example. There's many other examples I'm sure that we can give you. However, we're waiting for a little bit more of the details. As we all say, the devil's in the details. As at today's date, which is roughly the end of June, I believe the Division 296 legislation has passed the House of Representatives. It now will move to the upper house, or otherwise known as the Senate, looking to legislate this as soon as they can and being effective from 1 July 2025. I'll be talking about this a little bit more when the legislation draft bill actually gets legislated and all the amendments are done. And then we'll be talking about ways you can minimize your total superannuation balance to hopefully avoid a large portion of this unrealized tax on superannuation. If you're listening to us on iTunes and Spotify, don't forget to hit that like and subscribe button. Head over to our YouTube channel, watch some of the illustrations I've spoken about on Division 296, hit like, hit subscribe. I'm Jeremy Nuzzelli. This is what schools should have taught you, and I'll be seeing you next week.